Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to the Multifamily Wealth Podcast. On this week's quick solo episode, I'm going to be talking about just a simple strategy shift that I'm recommending a lot of folks make right now to stay active in the business and really to just, keep themselves in the game while there's all this turbulence between interest rates, what the market's doing. Some of it's just distress in the underlying fundamentals in a lot of markets where rents are going down and, expenses are going up, et cetera, et cetera. So, I'm a big proponent of, and I've always talked about this on this podcast and just, on my Instagram page of just starting small, growing slowly, just incrementally, buying the duplex, then the 4, then the 8, then the 10, then the 12, then the 20, right? And just trying to control your own destiny as much as you possibly can, right? Minimizing the amount of partners you have, minimizing the amount of investor capital that you're raising, and really solidifying the fundamentals of understanding the business before you start branching out and doing all kinds of other stuff, whether it's raising money, whether it's partnering with people, whether it's getting into a new market, et cetera. And I think that this is just a great strategy as well when you're investing in an uncertain time. And something that we're doing in our business is just not trying to grow that much in terms of like our average deal size. This time last year, our absolute goal was like, we want to start buying 75 plus, 100 plus unit communities. And that's where we wanted to take our business. We wanted to get into large multifamily. We're a partner on a few larger deals just as a minority GP, right? Somebody who's raised some money and has been involved in the asset management and understands that business. But like, that's just not something that we can really do right now. I don't feel comfortable raising money from investors to grow, to take down a deal that is a step up in what we've done, given what's going on in the market and given what the future of the market looks like. The deal would have to be so absurd for us to do that right now. Or else we just wouldn't feel comfortable. And there's not a lot of incredible deals out there in large multifamily because there's not a lot of distress in that market yet, outside of the idiots who use floating rate loans in the high growth markets, right? In markets like New England, which is typically less of a boom and bust market than the Southeast, Southwest, and other parts of the country. Just not a lot of great deals to be found that are larger, outside of just bad operators. But again, that's the exception, not the norm. So what we're doing in our business is just taking a step back and just looking at smaller deals again, really honing in on these small 5 to 20 unit properties where we can, very easily build a pipeline of them off market, where we can get in touch with owners that are more motivated by lifestyle situations. Maybe they want to retire. Maybe they want to move. Maybe they don't want to be in real estate anymore. Maybe, they own a 10-unit building and they're going through a few evictions and they don't feel like they can control the property anymore. And they just rather sell and get out and capitalize on the value that the market has given them over the last 5, 10, 15 years, whatever. And that's where we're going to start playing. And also from an operational standpoint, it is much, much easier to successfully predict the outcome of a small deal because there's just less variables. You're renovating fewer units. There's just less CapEx to worry about. You have fewer heating systems. You have maybe it's one building on the lot, so you have one roof, and you can easily determine exactly what it's going to cost to operate that property, right? And it's easy to project what your CapEx is going to be. It's very easy to actually execute on the project once you close because you're not renovating 75 units, you're renovating 15, 20 units, whatever it is, right? That's a much more easy process to manage. So for us, maybe that's, fear setting in a little bit and we're kind of retracting into our shells, but like, I'm okay with that because the market is not going up anymore. It's going down. Anyone who thinks that values aren't going to take a hit in the next couple of years is just I don't know how you even remotely have that opinion, because it's happening as we speak right now. Values are starting to take, a downward trajectory at the moment, even in the really resilient markets like, New England, West Coast, supply constrained markets that have been less affected by some of the migration patterns and what the market's done over the last couple of years. So that's just kind of, I think, and I encourage people to just think about their business outside of what allows us to grow despite what's happening, and to ask yourself, what allows us to stay in the game while this is happening? Because the goal is staying in the game. The goal is to not go to zero. The goal is to stay top of mind with all the important people in the market. The goal is to stay in the know in terms of what's going on day to day, week to week, in terms of values, rents, expenses, so that you can underwrite predictably or accurately, and you can accurately predict how a deal is going to perform once you close, and to stay on the front lines, to stay in the trenches, to keep your finger on the pulse, etc. And there's a lot of people that are just not buying at all for the reasons that I mentioned, where they're not confident that they can make a good investment decision today, or they're just not seeing deals that align with their investment criteria. And that's fine. I get it. I get, no shade thrown at those folks. But the downside to that is when you remove yourself from the marketplace, you're speaking with brokers less, you're speaking with sellers less, you're speaking with lenders less, you're speaking with your PMs less, and you have less of a sense of what's actually happening in the market. And you're losing an informational edge, which is really like what real estate is. It's just people who have more information than other people and making better decisions, finding the inefficiencies in the market and making more money and making better decisions. So if you decide, hey, I'm just going to play some golf and, I'm just going to operate the properties I got pretty well, I'm not going to look at any new deals, I'm not really going to get into that world at all. Well, you're going to be second, third, fourth place when the market, calibrates a little bit more and deals start to be a little bit more readily apparent, or you're just more comfortable with investing in that environment. So what we're doing in our business is the opposite. We're continuing all of the same activities that we were doing, over the last 5, 6, 7 years, but we're just doing them and pursuing smaller properties where we're making, less money, where it's more work for the same amount of money. And yeah, they're not what we'd like to be doing. We'd like to be doing bigger deals, but this is an opportunity for us to stay in the marketplace, to stay in the know, to stay on the front lines and still participate in the business, right? And the other piece of this too is if you're doing smaller deals, you're raising less money, or if you're using your own money, you're just putting less of your own capital at risk, and you're probably making more bets, but they're smaller bets. And if one of those deals goes awry, well, that's okay, because it's a smaller percentage of what you're actually doing in your business at that given time. So I highly recommend that, you recalibrate your goals a little bit. I know a lot of folks, they want to buy this, X number of doors, raise X amount of capital, do X amount of deals, whatever it is. You should be focusing on quality of deals. You should be focusing on deals that have very limited downside risk, but they give you an opportunity to achieve some upside potential. And I think that's just a much better way to approach the business right now as we speak. So hopefully this was valuable to you. If you felt that you learned something in this episode, or your perspective shifted a little, please consider leaving a comment, or not a comment, excuse me, a rating and a review for the podcast so we can get this in front of more folks. But as always, thank you for listening, and I'll catch you guys on the next episode. Thank you for listening to this episode on the Multifamily Wealth Podcast. If you learned something new during the show, please consider sharing this episode with a friend, family member, or business partner, or just leaving a rating and review, as it helps the show get noticed by more folks. Catch you next week.